So, when it comes to how we should approach theory questions and how we should be writing our theory responses in our SACs and in our exam, there are three goals that we need to be hitting. So, first of all, if the question is asking us to identify a specific term, so for example, if the question is asking how do we classify bank? Cash at bank. How do we classify cash at bank? So what that question is asking you to identify is the term, so the classification. So in that case, it would be a current asset, right? So that would be the identify part of that question, but you can't get the full marks for that question just by identifying the term, so just by stating the classification. You also have to go further and define that term. So you've stated the term current asset, so you'll need to define that term. So write the full correct definition for that term in your response. And then thirdly, you also need to link it back to the specific scenario in the question. So a lot of the times with accounting questions, there'll be like a paragraph or a few sentences of background context or just like an introduction to the question before they actually ask you what they want to be asking you. So for example, it'll tell you the name of the business, the owner, how the business, what methods the business uses, etc., etc. It might tell you the time period that you're reporting in, stuff like that. And that is what we call the context or the background information on the question. So third mark, or what examiners are really looking for, is students who are able to link their responses, their theory answers, back to the context of the question. So for example, that might just be saying the specific amount that was that current asset. Even just that. Or when it comes to other theory questions, specifically, discuss or explain questions that are a little bit more complicated questions, that's where linking it back to the context of the question is really, really helpful, and it can get you those extra marks. So it'll take you from getting like a 4 out of 6 to a 6 out of 6. So, and that's what we want to be aiming for, right? We want to be aiming to get full marks. And then just in general, definitions are super, super important in accounting. Pretty much it's impossible to get full marks on pretty much any theory question if you don't know your definitions. And a lot of the easier theory questions that are just like, referring to one qualitative characteristic. You need to be able to know all the qualitative characteristics, and you need to know the definitions for all of the characteristics. And the same goes for the accounting assumptions and for the accounting elements. So assets, liabilities, and that not current and non-current as well. The definition of owner's equity, the definition of revenues, the definition of expenses. So you need to know all of those definitions. So when we go back to the basics of accounting, the entire purpose of accounting, the whole reason that accounting exists is the role of the accountant is to provide financial information to the business owner, to whoever owns the business, so that the owner can make informed business decisions about their business. And in this course, so VCE Accounting, Units 3 and 4, we primarily focus on smaller businesses. And so because we focus on small businesses, usually it's just one business owner. But there could also be accountants for big corporations where there are multiple owners, or you're also advising shareholders as well. But in the context of VCE Accounting, we're only talking about small businesses, and we're also only talking about trading businesses. So we're not worrying about businesses that provide a service. For example, a massage place, right? Like the whole product being offered at a masseuse is the massages, which is a service. Instead of talking about those types of businesses in VCE units 3 and 4 of accounting, we only talk about trading businesses. So that refers to businesses that purchase like some sort of physical product from a supplier, and then they will mark up the product. So basically, they'll sell the products for a higher cost. So, for example, if um, they purchase these shells from a supplier. So, say if I'm the business owner and I purchase this shell from a supplier for $2, and then I'm going to sell this shell to my customers for $6. And that is so that I can make the profit. So that's what it means by a trading business. So basically it just means they purchase inventory or products from a supplier, they apply a markup or they increase the price, and then they sell it to their customers. And then you also need to know about the accounting process. So this just refers to the process involved, and the process that is required in order to get you to provide that financial information to the business owner. Because obviously you can't just take a brief look at a business and understand everything about the business and provide financial information and advice to the owner immediately. You need to go through a process. So that process is collecting source documents, recording those source documents, so recording the transactions, and then preparing financial reports. So that's your balance sheet, your income statement, your cash flow statement, and also budgeted reports. So budgeted balance sheet, budgeted cash flow statement, and budgeted income statement. Variance reports as well. There's a lot of reports. The point is preparing financial reports. And then once you have those reports, it's reading and analyzing those reports, and then based on the reports, providing financial advice and non-financial advice to the business owner. So that's your role as an accountant, is to basically look at the business, check their source documents, check their recording processes, prepare reports, and then provide advice. There are 4 accounting assumptions in VCE accounting, and you need to be able to know the name and definition of all of the assumptions. So the first one is the accounting entity assumption, and that assumption basically just states that the business has to be kept separate from the owner and any other entities involved in the business. So, for example, it needs to be separate from other shareholders. It needs to be separate from, I don't know, the owner's family as well. And this comes down to why we record drawings and contributions. So the whole purpose of recording drawings that the owner takes out from the business and contributions, so for example, cash contributions that the owner makes to the business, the whole reason why we record those transactions is because the owner and the business are 2 separate entities. And so we have to treat transactions between them as if it was a transaction with any other entity. Because some business owners think of, especially small business owners, because when you're a small business owner, you're really, really involved in your business. So a lot of small business owners sometimes think of their business as a part of themselves, which could be true, but financially they need to be treated as separate entities. The second assumption is the accrual basis assumption, which states that the business, so basically, there are 3 main components to the accrual basis assumption. So firstly, all revenues have to be recognized when they are earned. So that means that when the sale or whatever type of revenue it is, when it's earned, it needs to be recorded. And that's not necessarily when the cash for the revenue is received. Secondly, all expenses need to be recognized when they are incurred, which again might not necessarily be when the cash is paid, because obviously there's prepaid expenses and accrued expenses. And then thirdly, profit is calculated accurately as revenues and less expenses incurred. So basically, that sounds like a lot, but basically all that is profit is the most accurate when it only includes revenues that have been earned. So this is only including revenues that have been earned, and it's not including revenues that have been paid but not earned, and it is including revenues that have been earned but not yet paid. So we're kind of ignoring the cash in the situation. So we're ignoring when the cash is received for the revenues. We're just thinking about when the revenue is earned. And the same thing with expenses. We're only including expenses that have been incurred. So we're not thinking about when the expense was paid, whether it was paid in advance or whether it has yet to be paid. We only include expenses that were incurred in the current reporting period. And basically the assumption is when we do that, so when we only include revenues earned and we only include expenses incurred, profit is most accurate. The going concern assumption states that when we prepare financial reports and information, we have to assume that the business is going to keep operating indefinitely. So basically, we can't prepare reports expecting the business to close down. Or say if the business owner tells you, like you're their accountant, and the business owner tells you, hey, we're closing down next year, so they want the report prepared a certain way, you can't do that. Even if we know that the business will close down, we have to assume that the business is never going to close down and it's going to keep operating forever, basically. The reporting period assumption states that reports should be prepared regularly for a particular period of time. And this could be every fortnight, every month, every quarter, so on. The minimum period that reports have to be prepared for is at least once a year because of tax requirements from the ATO. So at the very least, businesses have to prepare their accounting reports once every year because the ATO requires that of all businesses. But a lot of businesses will choose to prepare reports every quarter or every few months or every fortnight or every week or every month. And the reason why is because the reports end up being easier or more useful to the business that way. So, for example, if there's a problem in how the business is being run, if you're preparing reports every month, you're more likely to pick up on that problem and fix the problem quicker, as opposed to if you have to wait an entire year to get a report, then you're not going to know about that problem, especially if it's a small problem that's kind of flying under the radar. You as the business owner isn't going to know about that problem until the end of the year when that report is given to you, which is why a lot of businesses prefer to prepare reports in shorter reporting periods. And the reason why we have these reporting periods is to ensure comparability of reports, which basically just means that we need to be able to compare reports from different periods. So the whole reason why we're able to analyze reports and figure out what's going well with the business, what's not working with the business, is because we can compare those reports to previous reports from previous months, previous years of the business, comparing it to reports from other businesses, like similar businesses to ours. For example, if we're a clothing store, comparing our reports as a clothing business to other similar clothing businesses that also prepare reports, and then also comparing current reports to budgeted reports. So if I predicted a certain outcome for September, did the September reports meet those budgets, basically? And those are the 4 accounting assumptions. So moving on, there are 6 qualitative characteristics. And again, you do need to know the term and definition for all 6. And I cannot stress that enough. It's so important that you know the term and definition for all the assumptions, all the characteristics, all of the elements, and even all of the financial indicators and all of that. But those aren't as necessary. These assumptions, characteristics, and elements are super, super important, which is why I'm kind of going through them. Because in the SAC and in the exam, you'll have a question like referring to one qualitative characteristic, referring to one accounting assumption, or classify this. So it'll give you an example of a transaction and it'll tell you to classify it as whatever element it is. And in those theory questions, just stating the term and the definition is 2 marks already. So it's literally 3 marks. Just like memorizing the terms and memorizing the definitions is such an easy way to get marks, just by knowing the definitions and knowing the terms. And you also save a lot of time by having it memorized. You don't have to be in the exam like thinking about, oh, what was that characteristic, or what was that definition. So it's super, super important that you start from now memorizing these terms and definitions. Okay, but anyways, so the 6 qualitative characteristics. So the first one is relevance, which basically just means that we need to make sure that in our reports, we're including all information that's capable of influencing business decisions by the owner. So this might mean even not including some information. For example, like if it's not as relevant or it won't make a big difference to decision making, we might be excluding that. But it also might mean that we really need to be including certain information into our reports because it is relevant to decision making. The second characteristic is faithful representation, which basically just states that our financial reports must be complete, free from material error, and bias free. So complete, that just means nothing is missing. You know, as accountants, it's obvious that you can make a mistake. So you forgot to include a certain transaction or a certain title in the report. So making sure that there's nothing missing from the report. There's no errors, so you haven't accidentally written the wrong amount or added an extra 0 or didn't include an extra, like 1 0 less, spelling mistakes, anything like that. So no mistakes, no errors. And then the third one is free from bias. So a lot of the times the owner is very biased, the business owner. So they want their business to appear a certain way. That's a very, very common scenario that you'll be given with your theory question is the business owner wants the report to come out a certain way. For example, you know, they want their profit to be higher, or they want, I don't know, more assets in the balance sheet, because obviously with a higher profit and more assets, their business will look better. Especially, for example, if the business is trying to get a loan, then the owner wants the business to appear in a better position because they'll be more likely to get that loan, or they'll be more likely to get a bigger loan. So that's just one example. But it's really, really important, even though the owner can sometimes be biased, that as an accountant, you stay objective and you kind of are able to ignore that bias, or like not let your own biases interfere. It's really important that you're just reporting the facts and the financial information completely objectively. And then obviously by doing this and by ensuring that your reports are complete, free from error, and bias free, this ensures that the reports are a faithful representation of the real world economic events. So basically that just means it's more accurate. It's more accurate to the real life event that the report is representing. Comparability means that we need to be able to compare our reports. Verifiability means that if different people, objective parties, were to look at our financial reports, they should all be able to say that our report is faithfully represented. So if you prepare your report and then you show 5 random people the report, all 5 of those people will be able to agree that your report is complete, free from error, and bias free. And that's just basically, yeah. And another way to be able to do that is if we make sure that all our reports can be evidenced by source documents. So, for example, if there's a particular amount, say if your balance sheet says cash at bank $5,000. If someone says, hey, where did you get the $5,000 from? You would be able to show the source documents and say, these are the source documents that I looked at, and show them how you got to that amount. And that's why source documents is really, really important to verifiability. Because a big part of being able to double check and verify your reports is going back to the source documents. Timeliness means that we should prepare our reports in time to influence business decisions, so don't prepare them too late. So obviously, if we're reporting for February, we don't want the report to be ready in, I don't know, May, because by then February was a long time ago. We want to prepare it in time for the owner to make decisions. And then lastly, understandability states that our report should be easily comprehensible to the people that are using them. So we shouldn't include any complicated language, and we should try to use visual aids such as graphs or tables that can help to summarize information. And that's because you have to remember, even though the business owner will have some financial knowledge or a reasonable knowledge and understanding of how business works, they're still not an expert in accounting. So our accounting report shouldn't include any jargon or confusing language. And then again, you can use visual aids to help achieve understandability. So if you have a question that's like, why do we use graphs in our reports? The answer would just be understandability. Okay, we have our first quiz question. So the question is, explain how the use of source documents supports an accounting qualitative characteristic. And if you remember, I said the characteristic that relates to source documents is verifiability. So the reason why is because financial information should be able to be evidenced so that different users can reach the same conclusion that it's faithfully represented. And when we have source documents as direct evidence of our reports, it supports verifiability. And as you can see in this response, I've hit all 3. So I've stated the term, I've defined the term, and I've linked it back to the question. And actually, this was a bit of a trick question because faithful representation would have also been correct here. Either or would have been fine, but it would have just been a similar explanation. So there are questions like that where it could be either characteristic, but you just need to pick the one that makes the most sense to you. Okay, here's our second quiz question. When we classify the balance sheet, which qualitative characteristic is supported? And in this case, it's understandability. And that might not have been obvious to you immediately, but the reason why is because when we talk about understandability, we want the reports to be presented clearly and concisely so that it's easily understandable to the people that are reading it. So by sorting out our balance sheet into these groups that make it easier to understand or comprehend, the people that are reading the report can easily identify which assets are current and non-current and which liabilities are current and non-current. And that, therefore, classification supports understandability of reports. Okay, here's the third question. So I kind of helped you with the first 2, but for this one, I'll give you time to think about it on your own. So with reference to one accounting assumption, explain why sales is reported as revenue. I'll give you like 1 minute. Just think about it and kind of come up with your own answer, and then I'll go through it. And if you need to, you can go back to the assumptions, because I know some of you might not have them all memorized just yet. Okay, so hopefully you all have something in mind. The answer is the accrual basis assumption, and this is because sales meets the criteria of being a revenue, and therefore it has to be reported as a revenue when it is earned, which will make sure that the business's profit is accurate for that period. And the criteria of a revenue just refers to the definition of a revenue. So we'll go through those definitions later, but it's an increase in assets that leads to an increase in owner's equity. Okay, so now we'll go through the accounting elements. There are 5 accounting elements, and it's really, really important that you know all of them and their definitions. The first element is an asset. It's a present economic resource controlled by a business as a result of past events that will provide future economic benefits to the business. So, for example, if you're talking about cash at bank, it's a present economic resource controlled by the business as a result of past events. So, for example, taking out a loan would be a past event that would lead to the business having cash. And it provides future economic benefits because obviously in the future the business can spend that cash to purchase assets, other assets, or pay off liabilities, for example, which will benefit the business in the future. And then obviously we have current assets and non-current assets. So the only difference is the exact same definition, but with current assets, those economic benefits will be provided within the next 12 months after the reporting period. And with a non-current asset, the economic benefits won't be within the next 12 months, and instead the asset is not held for the purpose of resale, and it will provide benefits for many years, or it will provide benefits for a period greater than just 1 year. The second element is a liability, which is a present obligation of the business as a result of past events. For example, a loan is an obligation of the business. So when a business has a loan, they're obliged to pay off that loan. So that's the obligation as a result of past events. So the past event in this case is the business taking out a loan. And it can be current, which means that when a liability is current, it just means that you can reasonably expect the liability to be settled within the next 12 months after the reporting period. Whereas with non-current liability, it's not required to be settled within the next 12 months after the reporting period. So for example, if you have a 3-year loan, obviously part of that 3-year loan will not be required to be settled within the next 12 months after the reporting period. But say that the business has a really, really successful period or a successful 3 months, and they have a bunch of extra cash lying around, and so they decide to pay off the loan early. Obviously, in that case, even though part of that loan was a non-current liability, they ended up paying the entire loan within 12 months. But that is an exception. So we basically say, can you expect this to be settled within 12 months, or is it not required to be settled within the next 12 months? The third element is owner's equity, which is basically it's whatever is left in the business out of our assets after we subtract liabilities. Because obviously the accounting equation is assets equals liabilities plus owner's equity. So whatever is left over in assets after liabilities have been deducted is the residual, which is the owner's equity. So basically, this is kind of a visual for you guys. So the business has a certain amount of assets, and then out of those assets, we subtract liabilities, and then whatever is left out of the assets goes to the owner. It's owed to the owner, so it's owner's equity. So, as I was saying, the accounting equation is assets equals owner's equity plus liabilities, but if we were to rearrange that formula to be able to find owner's equity, it would be assets minus liabilities. So you can rearrange the accounting equation. The fourth element is revenue. So a revenue is either an increase in assets or a decrease in liabilities that results in an increase in owner's equity, not including a capital contribution. So first of all, a revenue cannot be an increase in assets and a decrease in liability. It'll either only be an increase in assets or it will be a decrease in liability. It can't be both. So when you're, for example, if someone asks or a question asks, why is sales a revenue? You would have to say the definition, but you would say it's an increase in assets. You would not say sales is a decrease in liability, because a sale isn't a decrease in liability. So you have to be careful when you use this definition because it needs to apply to the specific revenue that you're talking about. And then the second interesting thing with this definition is it specifically states not including a capital contribution. So if you get a question that says, why is capital contribution not included as a revenue? You would just say it's explicitly stated in the definition of a revenue that capital contribution doesn't count. That's the only explanation you need to know, because it's stated outright in the definition of a revenue. And then we have an expense, which is kind of the almost sort of the opposite of a revenue. It's an increase in liabilities or a decrease in assets that results in a decrease in owner's equity, not including drawings. So once again, like a revenue, it'll either be an increase in liabilities or it'll be a decrease in assets. It can't be both. So for example, rent would be a decrease in assets because we're using our cash to pay rent. So we're decreasing cash. It won't be an increase in liabilities, and it can't be both. And then again, it's not including drawings. So if you get a question that says, why is drawings not included as an expense? You would say, because it's specifically excluded in the definition. Okay, so here's another quiz question. So the business borrows $20,000 as a 5-year loan. For each of the 5 years of the loan, the business will pay $4,000 to the bank until it's repaid. How would this loan be classified, and which accounting element would the loan be? So that's what classified means. It's just you need to classify what accounting element it is. So you need to say the element, the definition, and link it back to the question. So I'll give you 2 minutes to have a go. Try to, if you have paper, write your answer down, or even if you don't have paper, just think of your answer in your head and have it ready, and then I'll go through it. Okay, so I'll go through the answer now. So the element is a liability, and actually it's both a current and a non-current liability. So hopefully you caught on to that. So part of the loan, $4,000 worth, is a current liability because it will be paid off within the next 12 months. So within the next 12 months, within the next year, they need to pay at least $4,000 worth of the loan because it's $4,000 per year. And then the remaining $16,000 of the loan is a non-current liability because it will take longer than 12 months for the business to pay it off, and it's not required that they pay it in only 12 months. And you can see in the explanation that both of the terms have been stated and defined. So current liability was stated, current liability was defined, non-current liability was stated, non-current liability was defined. And you'll also note that specific dollar amounts are used. So it specifically says $4,000 and $16,000. That's really, really important to get full marks. And that is part of linking it back to the question because in the question tells you how much the loan is. So you need to be able to talk about how much is current and how much is non-current. Okay, here's the next question. The business has earned $6,000 worth of interest on a term deposit. How is this interest classified? And I'll give you a minute to think about the classification. Okay, so the correct classification is revenue, and that's because the interest earned is an increase in assets that leads to an increase in owner's equity that is in capital contribution. So it would be $6,000 worth of interest revenue. And again, specific dollar amount used, the term is stated, and the definition. Okay, next question. A business purchases a van for $20,000. What would this van be classified as? So I'll give you a minute again. Okay, so the correct answer is it's a non-current asset because it's an asset that the business will use for more than 12 months. And again, term, definition, and linking it back to the question by stating the specific amount. Okay, next question. The business owes $5,000 to their accounts payable. How is accounts payable classified? I'll give you a minute. Okay, the answer is current liability because it's an obligation that will be settled within 12 months. $7,000 of wages were paid by the business. How are these wages classified? Okay, the answer is that it's an expense. The wages are a decrease in assets that leads to a decrease in owner's equity, that is drawings. So it's $7,000 worth of wages expense. How would $10,000 of inventory be classified? I'll give you a minute. So it would be a current asset because it's an economic resource that will be sold within the next 12 months. So, as I mentioned before, the accounting equation is assets equals liabilities plus owner's equity, and this introduces us to the double entry system of accounting. Um, and there are two rules that are involved. Firstly, every transaction affects a minimum of two elements from within the accounting equation. So it could be assets, liabilities, assets, owner's equity, liabilities, owner's equity, so on. And the second rule is that the equation still needs to balance after the transaction has been recorded. So after you've made an entry of a transaction, the entire accounting equation should still be able to balance.